Hi all, good evening and welcome. I am Mangesh Deshmukh from the Corporate Communications team, and on behalf of CareEdge, welcome you to our today's discussion on specialty chemicals, sustaining growth despite headwinds. We sincerely appreciate your time in joining us for this webinar. This session will be moderated by Mr. Hardik Shah, Director at CareEdge Ratings. Hardik is a qualified chartered accountant and a CFA and has over 17 years of industry experience with a focus on corporate credit ratings. At CareEdge Ratings, he has led various rating teams across diverse sectors. We will commence this session with a presentation by Mamta, Associate Director at CareEdge Ratings. We will be followed by a discussion with our guest speaker. We will be having a Q&A session with the audience at the end of the discussion. Participants are requested to key in their questions in the panel. Now, may I invite Hardik to introduce the guest speaker and share the key messages for today's webinar. Over to you, Hardik.
Thank you, Mangesh, for the quick introduction. We welcome our esteemed guest speaker for today. Our guest speaker for today is Mr. P. Srinivasan. Mr. Srinivasan is associated with NOCIL Ltd as the Chief Financial Officer. He has rich experience of over 34 years in strategic planning, finance and accounts, corporate affairs, operations, MIS, regulatory filings, new business opportunities, debt syndication, and investor relations. Mr. Srinivasan is a commerce graduate and a qualified chartered accountant. My sincere thanks to our guest speaker for joining this session. Thank you, sir. Moving to our key messages for today's webinar. These are the key messages. There is a very good demand prospects for specialty chemicals being manufactured by Indian companies. This is mainly backed by robust domestic demand, along with demand for import substitutions and improved exports demand on the back of China Plus One policy being adopted by majority of the foreign countries. We expect a robust compounded annual growth rate of around 20% over the next 3 years, and post that, the growth is likely to be supported by large size capex being undertaken by Indian specialty chemical companies. Looking at the various subsegments of the Indian specialty chemicals, we have observed robust performance of many subsegments like fluorochemicals, amines, agrochemicals, whereas performance of paint-related chemicals and pigments stands impacted in the current year 9 months of FY23. On the back of cost side pressure and demand slowdown due to global recessionary conditions, we expect some moderation in the operating profitability of the Indian specialty chemical companies. Albeit, the same is expected to remain very healthy. The operating profitability margins had improved significantly during financial year 21 and 22. This was mainly on the back of supply chain disruptions and high logistic costs associated with the imports. The said margins are likely to normalize now. Credit profile of the Indian specialty chemical companies in general is expected to remain strong, backed by their strong balance sheets and the strong liquidity profile. Post this presentation, we will have a discussion with our guest speaker and then a question and answer session with the audience. With this, I request my colleague Mamta to start the detailed presentation. Over to you, Mamta.
Thank you, Hardik. Before we begin the detailed discussion, I would like to take you through the topics that we intend to cover in today's presentation. In today's webinar, we shall start with the size of India's specialty chemical sector, along with its growth trajectory vis-a-vis size of global specialty chemical sector and its growth. We will look at the performance of 5 key subsegments of specialty chemical sector, China-related factors which are in favor of India, long-term growth drivers and near-term headwinds, key sector monitorables, and then we shall conclude with the rating dispersion of CARE's portfolio of specialty chemical sector companies. In terms of growth, India's specialty chemical sector is outpacing the global specialty chemical sector. The figure on the left side of the screen depicts the size of global specialty chemical sector and its growth, whereas figure on the right side depicts the same aspects for the Indian specialty chemical sector. As we can see, compared to a 5.7% growth of global specialty chemical sector over the last 5 years, Indian specialty chemical sector has grown by 12.2% during the same period. Post-COVID, the growth in India has improved even further to 17.26% in the last 2 years ended fiscal year 2022. Going forward, the global specialty chemical sector is expected to grow by 7.78% by FY25. However, India's specialty chemical sector is expected to grow by nearly 20%, and that too on an already increased base of 44 billion USD. Even with the significant growth, India's share in global specialty chemical sector would improve from less than 3% in 2015 to around only 6% by FY 2025. This signifies significant growth potential in the long run for the domestic sector. Now let us have a look at the overall sales growth and margins. To plot the trend of sales growth and operating profitability margin, we have considered the data for top 36 listed specialty chemical companies, which covers over 50% of the market size. Figure on the left side of the screen shows the trend of sales growth. The sector had started the traction even before FY18. Sales growth was marginally impacted in FY20 due to impact of COVID in the latter part of the year, whereas in FY21, it was substantially impacted due to the widespread outbreak of COVID during that year. Subsequently, sales growth in FY22 was abnormally high due to pent-up demand as well as the low base of FY21. Going forward, we expect nearly 20% sales growth to continue in FY23 and FY24, backed by both volume and value growth due to the robust domestic demand as well as exports demand. This is also due to the China Plus One policy adopted by the major global economies. The figure on the right side of the screen shows the trend of operating profitability margin. Operating profitability margin stood healthy for specialty chemical companies at around 18% to 19%. It went up in FY21 and FY22 due to supply chain disruptions due to COVID, as well as the low raw material prices. However, with the normalization of supply chains, a reduction in freight costs, and elevated raw material prices, the margins are expected to now normalize to its earlier levels in the short to medium term. In today's presentation, we shall discuss the trend of key financial indicators of 5 major subsegments of specialty chemicals, which are fluorochemicals, amines, agrochemicals, paint chemicals, and pigments. Now we'll have a look on each of these sectors, how they have been doing. So we see that fluorochemicals is flourishing. It is one of the better performing segments of specialty chemicals. Operating profitability margins here continue to improve over the last 4 years on the back of improved exports and CRAMS business from the foreign countries. Due to a very good demand prospect, companies in this segment have nearly incurred 10,000 crore of capex in the last 3 years, and a similar size of capex is underway to be completed by end of FY24. So in spite of this large size capex, the capital structure of the segment continues to remain comfortable on the back of healthy internal accruals. One of the key raw materials for this segment is fluorspar, where basic customs duty on import is reduced from 5% to 2.5% in the recent union budget. This is likely to help the sector marginally in FY24. Now let us look at amines. Talking of amines are helping in import substitution. Amine products have mainly applications in pharma and agriculture. Over the years, Indian companies in amines business have developed products which act as an import substitute, and now the same are being exported also. But during FY21, due to supply chain disruptions and high cost of freight, imports were limited, leading to significant improvement in operating profitability, which has now normalized in FY22 and the 9 months of the current year. China Plus One policy has helped the sector in FY22, leading to improvement in exports. Over the last 3 years, capex of nearly 650 crore is completed by the segment, and further capex of nearly 800 crore is underway in this segment on the back of healthy profitability and good demand prospects. Capital structure has also improved for this segment, backed by the healthy internal generations. Agrochemicals is one of the largest sub-segments of specialty chemicals. Good monsoon in India in the last 3 years, along with increasing exports, have resulted in healthy operating profitability margin for this segment. This is a highly capital-intensive segment, wherein capex of nearly 17,000 crore is completed in the last 4 years. Further capex of nearly 10,000 crore is underway on the back of very good revenue visibility in the form of export demand, with exports contributing nearly 70% of total sales. Due to capital-intensive nature of business, capital structure is moderately leveraged, but due to healthy internal accruals, it has improved over the last 4 years. This is despite the large size capex being taken by the companies. Timely compliance with evolving pollution control norms would be critical for the growth of this segment. Here we have covered the performance of the companies catering to the paint companies. These are specialized chemicals used by paint companies. This is largely domestic demand driven business, wherein the performance stands impacted in the 9 months of the current fiscal due to slowdown in demand for decorative paints. This segment is relatively new, and we saw sizable capex of around 1,500 crore in the last 3 years ended FY22, while capex of around 1,100 crore is currently underway, mainly looking at the significant potential in this business. Capital structure continues to remain comfortable here also. Pigments is one of the worst impacted segments of specialty chemical sector. Operating profitability margin was impacted in FY22 due to cost side pressures, whereas upon imposition of anti-dumping duty by China on import of pigments, performance stood severely impacted in the 9 months as well. Moderation in operational performance along with large size capex has impacted capital structure, leading to worsening of the overall gearing. However, with gradual reduction in import duty by China, along with clearance of high cost inventory, performance is expected to improve from FY24 onwards. Here we have listed down various China-related factors which are in favor of India's specialty chemical sector. Unlike earlier times, now China has put a great thrust on stringent environment compliance, which has resulted in high cost of compliance for Chinese companies. Also, various fiscal incentives and subsidies in finance cost has been curtailed by China, giving a level playing field to Indian companies. Various instances of plant accidents and stringent COVID-related policies adopted by China compelled foreign countries to look for a reliable alternate source of supply, and China has always kept its disclosure levels low, which has been a discomforting factor post-COVID. China has increasingly shifted its focus towards volume-driven basic chemicals business to gain a good command over the global markets. This has provided a space for Indian companies to focus on specialty chemicals and emerge as a reliable and equally economical source of supply to the world market. As we discussed initially, the Indian specialty chemicals sector is expected to grow by around 20% in coming few years. The same is expected basis these growth drivers. First of all, we have a robust domestic demand wherein there is very good scope of import substitution as well as backward integration to reduce dependence on China for raw materials as well as intermediates. China Plus One policy adopted by foreign countries is expected to result in significant ramp up in exports from India. In terms of cost structure also, India is one of the low cost manufacturing hubs in the world market. Government's push for Make in India and expected rollout of PLI scheme should further aid to improved demand. Sizable part of recently concluded or ongoing capex is either towards backward integration or backed by some firm medium-term business commitment by the global players. This reduces the project risk to a large extent. Like pharma sector, specialty chemical sector also has significant potential from CRAMS business, considering the vast differences in product development costs in India vis-a-vis the foreign countries. Having discussed about the key growth drivers for India's specialty chemical sector, these are some of the near-term headwinds for the sector as we see it. China is a dominant player in the world market and has the ability to disrupt the market with its large economies of scale. There has been high dumping by China in some of the product categories on the back of its sluggish domestic demand. Prices of the raw materials for specialty chemicals have some or the other linkages to crude oil prices. With high crude prices on the back of geopolitical reasons, raw material prices continue to remain elevated. On the other side, sales realizations have moderated due to demand slowdown. Also, rupee depreciation impacts as there is sizable import of raw materials while it helps the export-oriented units. There is an ongoing recessionary scenario in global economies, and in that backdrop, the demand for exports is likely to be impacted, which again can put pressure on the profitability of Indian companies. Cost of environmental compliances has increased in India also, post high thrust being given to stringent compliances with ESG norms. These are some of the key monitorables which are expected to drive the fortunes of the sector going forward. Looking at the factors from the left, the first three factors are related to the demand side. Revival of demand in China would be critical, whereas demand prospects from US and EU would also be critical to drive exports from India. Major global economies have taken a stand for China Plus One policy, but consistently following it would also be an important monitorable. Balanced three factors are related to the cost side. Ability of India to be cost competitive given the high dependence of China for basic chemicals would be important. Due to geopolitical situation, increase in crude prices beyond a particular level could impact the profitability of the sector. Also, ability of Indian companies to keep their cost of environment clearances at a reasonable level, even with full compliance, would be important for long-term sustainability. CARE has rating on around 40 companies in the specialty chemical sector, and this is the dispersion of CARE's rated portfolio of companies. Majority of the companies in our rated portfolio are in the A or AA category. This is driven by healthy growth in their income with healthy profitability, comfortable capital structure, strong debt coverage indicators, and strong liquidity profile in spite of the ongoing capex. Thank you. With this, I conclude the presentation here. Over to you, Hardik.
Thank you, Mamta, for the insightful presentation. Now it's time to seek opinion from the expert in the field, our distinguished guest speaker. So my first question to you is, we saw in the presentation, currently there is a sizable exports from each of the subsegments of the specialty chemicals. And the share of exports is growing on a YOY basis in the last couple of years, which is actually helping to report the superior profitability margins. In this backdrop, how do you see the impact of global recessionary scenario on the profitability of the specialty chemical sector in the near to medium term?
Thank you, Mr. Hardik Shah, and other members of the CARE team, and distinguished panel who is sitting there, and also the listeners who are on the webinar. To answer, it's a very tricky question the way you have asked it, because today we are still yet to consolidate the business. But what we are getting the impression from the marketplace is that the recession is still not over. But the good thing is the interest rate hike, those are getting tapering off. We are seeing the final leg of the interest rate hike across the economy, which essentially is a good thing. And we believe over a short-term period, maybe 3 to 6 months, we can see the bottommost period will be over. Thereafter, the consolidation will start. Having said that, the other development which has happened recently is in China. This economy faced a lot of COVID lockdowns and shutdown and on and off quite regularly the last 6 months or 9 months. But what we are hearing today is, in the reports which is coming out of various economic reports coming out of China, is indicating that there is a pent-up demand likely to build up. And we have already started witnessing those in some of the prices of inputs of some of the specialty chemicals. Some of the specialty chemical prices are going up, chemical prices going up suddenly out of the blue because the domestic consumption has buoyed. So if these indicators continue, it's a good sign. So I think the recessionary outlook, one need not worry. Yes, it is there, but I think it should get tapered off as we go along.
Understood. So my next question is on the ESG aspect. There has been ever increasing awareness about the environment, social and governance factors. And for the specialty chemical sector, E factor is more so relevant. Given the fact that we expect exports to contribute a sizable part of the growth of the sector going forward, in your view, how is India's specialty chemical companies placed in terms of their ESG compliances vis-a-vis their global counterparts?
I think on the ESG, the awareness is very important. See, one is the awareness, second is the implication of that awareness, whether you intend to implement it, and the third is the implementation part. I think India, by and large, has crossed that awareness barrier. So people are aware of their responsibility. And people are also aware that India is an emerging market. It's a very hot market from an investor perspective. The global investors are also viewing companies which are ESG compliant. They rate those companies very differently as compared to those companies who are non-compliant or who are not focused on compliant to ESG norms. Once you see the benefits of such stakeholders' interest in such ESG thing, it's a time where everyone will comply. And I think by and large, the Indian companies have over a period of time have made an effort to improve their ESG adherence. And I believe these are all good signals. And I believe in this coming year, you are going to see more and more ESG reports coming out, more and more positive outlook from the industry. And more so, the consumers are also having huge demand or huge expectations from the suppliers. It's not ESG compliant from a stakeholder perspective like a shareholder and an investor, but you are also looking at from a consumer. If a consumer of an industry is keen on reducing his recycling or cycling of waste or reducing his waste to the environment, then he is going to put pressure on the supply chain also. Like for example, we are in rubber chemicals, which is basically supplying the inputs to the tire industry. The tire industry is very keen to reduce its carbon footprint. Obviously, when he is doing that, we have to need to necessarily follow that. So there is two-fold pressure. One is an internal pressure that you need to achieve something. Therefore, for that, you are seeing the stakeholders like investors are looking at it very critically, as also your business associate or chain partners. So it's a very conducive environment where everyone is making an effort to comply with it, and I think India will definitely improve over the years to come. And in this year, we are going to see a remarkable change. At least when you see the annual reports coming out, you will be pleasantly surprised to see lots of initiatives taken by many companies.
Right. In fact, a couple of companies have voluntarily started
disclosure in FY22 also.
Disclosures, yeah. So many companies have started putting the disclosures, and those are really good disclosures. At times we have come across, so which gives a lot of confidence when we read the companies also.
And many of the chemical companies, especially many of the chemical companies, are in responsible care. Add to it, and being part of responsible care, you are already compliant to a lot many compliances, and you are actually announcing to the world that you are a responsible corporate citizen. So having complied with some of those parameters, this is an extension of that. Large part of ESG compliance is already handled by the responsible care aspects. So if you are a responsible care chemical company, automatically you will be getting into ESG very sooner than later.
Right, sir. Right. It's really nice to hear that Indian companies are conscious about the ESG part, and they are consciously working towards that. So, sir, next question is around the China Plus One policy. There is a lot of noise around China Plus One policy being adopted by global economies and its consequent benefits to the specialty chemical sector companies in turn. Sizable capex is also being undertaken by Indian companies basis the good demand prospects basis this China Plus One policy. So here we would like to hear your views. How far it would be a game changer for the Indian specialty chemical companies? Will this policy be continuously adhered by its spirit, or do you see some flip-flop in between which could impact the Indian specialty chemical companies? What's your say on this, sir?
I think if you see the slides just displayed by Mamta just a few minutes back, the indicators are very clear that India's 3 to 4% of the global share of the chemical specialty chemical segment. I think specialty chemicals per se is about 20% of the Indian chemical sector. The Indian chemical sector must be about $250 billion. So if you're talking about 50-50, around 50 billion is the specialty chemical business today. And when you are having reports that you are likely to grow by 18 to 20% per CAGR growth, which means every 4 years or 3.5 years you're going to double, why would anyone not spend on those capex?
Correct.
In China is there. Again, your technological capabilities. What is specialty chemicals? Is technological capabilities, and Indian entrepreneurs with their technological team have displayed a lot of potential and delivered lots of assurances in the last 10 years. If you see the chemical segment in the last 6-7 years, it has grown at 15% CAGR. It is likely to grow at 9%, and specialty will obviously be double than this. And when you are intent to globalize, you intend to be as somewhat an alternate to China, obviously you need to have a capex, right? And I think that will be, it is but natural, it is a natural flow of movement. When the potential is low, looking so bright, definitely you will be people will not hesitate to spend money on that capex.
Right. So you expect this to play a major role, China Plus One, in terms of specialty chemical? Yeah.
You have to look at very differently China Plus One. It depends on the industry in which you are and the China's market share in the global space. Now, let's put it very differently. Suppose China is occupying a 50% supply chain space in a particular industry. And if you want to de-risk by 10%, the customers who want to de-risk by 10%, it's only 5% from China. But what happens is, in the non-Chinese market, it's a straight 10% growth. Just shift. Now, it all depends on industrial sector to sector and the specialty chemicals in which we are. But ultimately, the customers decide what they want. It's a fact that Chinese cost of compliances is going up because they are also making serious efforts to improve their compliance to environment, which is what your slides also talked about. So when their cost of production is going up because of increased compliances, when they are downsizing all those small industries and consolidating to medium-sized industries or big industries, which means these are all very clear messages. Now, the best example which you can see is the level of pricing which happened from post-COVID. In COVID, I think during COVID, just the start of COVID, the crude came to $40 a barrel. Straight away, it went to 70 or 65, 70 thereafter in about 6 months' time or 7 months' time. You see, you take any building block, all base chemicals, if the index was 100 during 40, when the crude was 40, everything went to 200 or 220 straight away.
Right.
And everything was, and you suddenly saw everyone ruling in a high price regime, high cost and a high price regime. And China was not hesitant to do corrections, which means what? When your increased cost of compliances are happening, when the market is going up, people are not looking at the value, they are looking at the value chain, value proposition, which they are going to build on it. And China has been instrumental in changing their facelift over the last 2 years. That's what we have seen. Having said that, what has happened is, from a customer perspective, they look at 3-4 issues from a supplier. Whether the supplier is able to give the supply in the right time, the right quality, the right price. Now, for the right time is very important, whether you can be depend on the supply chain. And I believe China unfortunately faced a lot of accidents in the last 3-4 years, which gave us some sort of a shock to the consumers or customers of their product. And therefore, the de-risking China concept came in. And we are able to see the benefits of that traction moving, and it is building on.
Right. Correct. So to sum it up, it's not only the COVID. This China Plus had already started much before COVID, and it got acceleration once COVID hit us. And now it's likely to be pretty much there going forward. So my last question to you is in the basic chemical segment, if you see, China has a clear advantage due to significantly large economies of scale. But especially in the specialty chemicals, how do you see the India's cost competitiveness vis-a-vis China? Basic chemicals, they are definitely having a cost advantage, but we would like to understand how is the situation in the specialty chemicals segment, because this is not a volume-driven business largely.
Just to reiterate a bit, I think what is happening with the Chinese entrepreneurs, whenever there is an economy of scales they operate, they generally tend to operate on a global economies of scale. Obviously, because of that, they tend to get some optimization benefits or leverages out of better optimization, a larger volume base on their energy cost as well as on their fixed overheads. But what we notice, at least what we have observed in the study which we have done, is that on the technological front, we find the Indian companies are still competitive because China is still the beneficiary of some of the state government policies like subsidies, export tax rebates, provincial state subsidies, and so on and so forth. Now, let me give you one example. One of these companies did a study on anti-subsidy petition with China. And to my surprise, and that's what the conclusion one of the advisors said to this, that in China, we had about 100 state subsidies, which is floating around in various forms. And none of us are aware. When we get into the nitty-gritties, we'll understand that. Now, having said that, so their cost competitiveness in a way goes up very significantly when you're competing with the rest of the world. Now, let me give you an example. What I'm trying to say is that if you are expecting a price, expecting a cost of a product, say unit of 100, and the subsidy is 10, then you are effectively pricing at 90 or below, around 90 level in the market. And you are seeing the Indian companies competing around 90, which essentially means that Indian companies do not enjoy those subsidy benefits. Still, they are able to compete at 90. In effect, what you're trying to give a message is that Indian companies are technologically superior. So that is one area where the Indian technology is much ahead of China, is what we believe. Of course, there are always scope for improvement. And that is where we see, and if you see a lot of initiatives taken by Indian companies to improve the technology. Especially, I think we can see the fluorocarbon, they have done very well in the last few years and see the capex they're spending and see the returns they're doing. It's excellent. So, what we are trying to understand is when you give, India is giving an alternate to China in terms of dependability of supply, in terms of technological capabilities, and therefore they are still able to compete despite China getting a state support to the extent whatever is available.
Right. So, now, I'm sure the audience has been anxiously waiting and they have a lot of questions. So we'll have the Q&A session, and I request if Mamta can compile the questions from the audience. Over to you, Mamta. You can direct the questions.
Yeah. We have received quite a few questions, but considering the paucity of time, we may not be able to take all of them. So, Hardik, I would request you to take this question. So, large size capex is undertaken in the recent past, and sizable capex is underway till FY24. So, do we expect the sizable capex to continue in the medium term?
Interesting question. So, we saw in the initial part of the presentation that share of India's specialty chemical sector in the world market is not going to be more than 6-7% even by FY25. And that too, even after expecting a nearly 20% of compounded annual growth rate in the sales for the coming 2-3 years period. So accordingly, number one, India has the potential to expand its share in the world market, definitely. Number two, the ongoing capex is largely towards backward integration, existing capacity addition, or import substitutions. But we expect going forward, once there is a good acceptance of India's specialty chemicals, which is actually happening, there would be a sizable capex in the forward integration and new product segments. Size of capex in those particular segments could be substantially large, as it would also entail a lot of investments in the research and development cost also. So we expect sizable capex going forward. Additional factor is the prevailing capacity utilizations. If we see, they are already operating at an optimum capacity utilization. And the plant capacities which are going to come on stream in this year and next year, if we go with the existing run rate, they should also be exhausted more or less by FY25-26. Accordingly, we would be left with no option other than to go for a capex for the next phase of growth. Otherwise, growth won't be possible. Number four, existing balance sheets. If we already discussed on all the subsegments, and we saw most of the subsegments, the capital structures are highly comfortable. So most of the segments are having a comfortable capital structure, low debt level, and having a healthy liquidity profile, which allow them to go for a large size capex going forward. And lastly, specialty chemical sector being a net export earning sector, it would continue to remain in the focus of the government while framing any policy related schemes or support schemes. So to sum it up, in case we see a good visibility in terms of export demand in the coming 1 year or 2 years period, we could very well see a sizable capex to continue even till FY30. I hope I have answered.
Can I add something?
Yeah, sir. Would you like to add anything here?
Yeah. Basically, if you see one thing, Mamta made a statement that it is likely to grow at 20% per growth CAGR. And today we are looking at $50 million and the size of the specialty business in India. And if we are looking at $100 million in the next 5 years, I think she said 75 by 25, 26, something like that. Maybe I'm seeing something more also. Now, for this 25 billion, even if you take an asset turnover ratio of 1:2, which means $11 billion, it's not a small amount. It's a sizable amount.
Right.
The next question is for Srinivasan, sir. Post onset of the Russia-Ukraine war, we saw an energy crisis in Europe, and it had a definite positive impact for the basic chemical sector companies in India. But how do you see the impact of Europe's energy crisis for Indian companies in the specialty chemical sector?
It depends on the business in which you are operating. Having said that, what we gather the information is that energy cost being so prohibitively expensive, some of the multinationals are shifting their production base to some other continents. That's what we understand. Availability of energy was an issue there in Europe. Luckily, the winter was not that severe as was originally anticipated. So, one should not be surprised if you can expect production base shifting from Europe to some other places, especially the multinationals. And you can also see some layoffs being announced in the coming few times. And I believe BASF or someone has announced very recently last week some layoffs. So, these sort of actions will be there. But I think what they will look at, they will be selective with the products in which their operating margins are excellent. They will continue to operate there where their markets the prices can absorb. Where they are not in the position to absorb, they may shift their production business. I mean, if you don't see a solution to this energy crisis looming around Russia, Ukraine.
Yeah, really good thoughts on that. Yeah, sir.
Yeah. So Hardik, if you can take this question, do you really see a significant potential for CRAMS business model in India's specialty chemical business, and what would be the key drivers for the same?
Yeah. So to answer your question, I would first of all like to explain how exactly the CRAMS model works here. Here, a unique molecule or a product is developed under the direct guidance, or you can say a supervision of the innovator or the patent holder of that particular product or a molecule. This is really a long-run process, and it takes nearly 2 to 3 years, or even at times more than that, depending on the complexity involved in the development of that molecule or a product. Once product is developed, company need to produce that product and supply it to the patent holder or the innovator for a reasonably long period of time, which gives you a very good revenue visibility once the product is developed. So we expect there is a significant potential in the CRAMS model in the specialty chemical side also, because of the several factors. Like, to start with, cost of development of the product in India is far more economical when you compare it with the development cost in the developed countries, which is mainly backed by the high manpower cost there. Other costs are also high on those side of the countries. Second aspect is post-COVID, there is a lack of confidence on China for the CRAMS model due to their low regulatory disclosures, as you already shown us in the presentation. Third aspect is because of these China-related issues, taking advantage of that situation, Indian companies have been very aggressive in their pricing for the product development cost. As subsequently, once the product is developed, they would have a sizable margin-driven business from the innovator, and that would be for a reasonably long period of time. So they are charging low for the development cost, given the fact that they have a very good visibility as far as the continued business with a high margin for a reasonably long period of time. So that's why this model is doing good in some of the sub-segments of the specialty chemical. We saw encouraging results from the CRAMS model in fluorochemicals and agrochemicals. There is a demonstration of the good performance in these two segments. And taking lessons from these sub-segments, we expect this model to be replicated in the other sub-segments of the specialty chemical also. Also, going one step beyond, post the expiry of the contract period for the CRAMS model, with the years of experience, Indian companies would be able to introduce the innovative products in the domestic market, which will help them in the better absorption of their fixed cost. This would be for the long run. So we expect significant potential. The only concern or the area where specialty chemical companies need to be cautious is that there should be a tightly worded contracts for the CRAMS model, leaving no scope to backtrack by the innovator, mainly because they would be incurring large size capex here, looking at the long-term revenue visibility. So the contracts or the agreements which you enter with the innovator, those should be very tightly worded so that there is no room for any backtrack. Barring this, personally speaking, I expect a significant potential from the CRAMS business in the specialty chemical also. Yeah.
Mr. Srinivasan, this is the question for you. How are Indian specialty chemical sector companies placed in terms of their ability to pass on cost escalations in their pricing?
I think by nature, specialty chemicals is not different from commodity chemicals. Because in specialty, why it is known as specialty is that it is either in the form of specialized applications or technology-based applications, or the competition is relatively minimal. So what we understand is specialty by nature, you don't have huge capacities, as Mr. Hardik Shah just sometime back pointed out. They don't have much capacity to run with, play with. So it's an application-driven business where you need to explain to the customer the benefit of a specialty chemicals in his downstream application, and there is a value proposition which you are giving the customer. Only then the specialty chemical market. That means it's a slow market penetration. Once you get in, it's a long-term business, as sure. So, likewise, we also have certain specialty chemicals where we supply to our hair industries or other downstream industries, where we develop certain product properties which is useful for a particular application in the customer's end. And once that is assured, the customer will pay a value. And that value is generally, we normally get some cost for some percentage. Obviously, when competition comes in, you will have some competitive scenario. We are not denying that, but it will not be as severe as the Chinese competition in a bulk chemical or a base field. It will be relatively less competition. So, by and large, what we have seen is it's just cost plus scenario. The day it gets commoditized, then you are going to get into the price pressures. So far, it is always called a specialty till system. It is not commoditized. The day it gets commoditized, then it is no longer a specialty. The definition of specialty undergo a change.
Right. But this pass on typically happens with some lag or something, a quarter or so. So typically that is what we have observed, or how do you see that?
It depends on at what situation you are getting into. But what happens typically in specialty chemicals, I personally feel over experience which we have studied is the margin pressures are not much severe. It is always maintained. It's hardly 1 or 2% here and there. If you see the graph which you showed in the first time, it was showing 18, 19, maybe 21, maybe 19, 17. So it's a plus or minus 10% bandwidth. It's not going to materially change in percentage terms. What is more happening is sometimes you cover stock much more than what you wanted, and suddenly there's a degrowth happening, and to that extent you are getting into a legacy cost, high cost carrying forward. So typically what happens in a recessionary scenario, what happens is a manufacturer buys raw material on the assumption that his operating rate is 100. Tomorrow suddenly the operating rate comes down to 90, and that's why he's got napping. Then these legacy costs come, and in that particular quarter you may have some profit aberrations, margin inflation. Otherwise, I don't see in specialty it's your margin pressure will be severe. It is relatively stable. The only thing is, if you are having a volatile specialty, then you cannot call it any more specialty. It's a commodity.
Correct. Understood.
So there is a question on the outlook of caustic soda or alkali industry in India or world in terms of pricing and demand, and can the industry witness similarity to specialty chemicals going ahead? Hardik, if you can take this.
Yeah. So typically caustic chlorine is a basic chemical. So it doesn't fall under the specialty side then. And what we have seen on the caustic chlorine, it's a highly cyclical industry. And post FY21, I think there had been a couple of years of very low realizations. FY19 onwards, it started, continued till FY21. And post COVID, 22 was one of the best years, wherein the typically we call it as the electrochemical unit realization, ECU realization, which is a blended realization of caustic, chlorine, and hydrogen, which went up from a level of say 20,000 to almost 40, 50, 60,000 also it touched at times. And again, now it has started moderating, but still it is a decent number. We see all the caustic chlorine companies are doing fantastic. So it's, I would say, an extended run. We haven't seen such an extended run in the caustic chlorine business typically. It is normally once in a 3 year, 1 year would be a good run, and then you'll have a subdued performance for the 2 to 3 years. So this was backed by a couple of factors. As we already discussed, Europe has an energy crisis, and this caustic chlorine is highly power intensive business. Power cost would be almost 40% of the cost of production. So because of this high energy cost, Europe is unable to produce this product, particularly in the domestic market. So there is very good export demand coming in from that part of the world, and which is helping the good realizations. I don't see there is any correlation whatsoever for a caustic chlorine vis-a-vis a specialty business, because specialty chemical would be consuming caustic, but not to a significant extent. It would be very minuscule in terms of their total cost of production. So I don't see any correlation there between caustic chlorine vis-a-vis a specialty chemical business per se.
Okay.
Yeah. Sir, do you have any additional input to this? Or
I think caustic is not a specialty anymore. It's not never called a specialty. It's a base chemical only, as you rightly said. It's a high volume business, and where the power cost is a very significant cost in the input cost, overall cost of production. Yes, you had a very nice year in 2022, where Europe was ready to pay the price for the move. I mean, they were ready to pay any price what you demanded. Some moderation has happened, but nonetheless, it is much higher than the base level of 2020 or 2019. So it cannot be called as a specialty, and it's a high volume business. If I'm not mistaken, it's about 40 lakh tons India.
sorry, sir.
India is about 40 lakh tons.
Yeah, even more than that, I think, because last couple of years, lot of capacities have come on stream, and the sizable capex.
I'm not aware of the business, but I think 40 lakh tons is a very, very high business.
Yeah. And sizable capacity is expected to come on stream this year and next year. So we expect these numbers to moderate, profitability margins to moderate, because sizable capacity is coming on stream.
In what happens in caustic chlorine, you also have hydrogen along with that. So you will be able to sell hydrogen, and you are getting into, and especially it is more prevalent in a chemical zone.
Correct.
Yeah. So Hardik, there is another question on the outlooks of amines segment and what has gone wrong for them.
I believe nothing has gone wrong with the amines business. Probably the question is coming from the looking at the third quarter performance only. We have shown in the presentation the margin numbers which we have seen over last 4 to 5 years, and even the 9-month numbers also. If you see, it is a decent number, upwards of 20%. Anything, any business you take is a good margin. Third quarter was an abnormal quarter. What I understand while hearing from the industry people is that there are particular raw materials which goes into manufacturing amines, and there is some dependence on the China for this particular raw materials, and there had been some shortage as far as availability itself is concerned for these raw materials, for the aliphatic amines and methyl amines. So which probably impacted margins a bit, but I would say it was more of a normalization of the margin rather than the moderation in the margins. The margins had been already at an elevated level, 30-35% margins we saw in the first and second quarter. So which is not a normal business margin. So those were already an abnormal number, and which has probably normalized. So I don't see anything wrong with the amines business. That is doing fantastic.
Just to add a bit, I don't know, when you are having 18-19% EBITDA margins or operating margins, and if your asset turnover is 1:2, or I don't know what is the ratio 1:2, what is the analysis that you are to tell me, which means you are looking at return on capital employed of 40% or 38%. It's a very healthy business.
Correct. So these companies have a ROC of upwards of 30%. If you see, so that is a good enough return to the capital which they have been employing, and that's why precisely we see a significant capex also happening in this particular space.
So there's a question on expected sales growth in FY24. considering that inventory levels have declined by December 2022. So, Hardik, would you like to answer this?
Yeah, so probably I won't be able to comment that the inventory level has come down by December because listed companies do not publish the balance sheets. So I cannot get to know what has been the inventory level. Whatever number which we have is the inventory numbers up to September 22. But I understand while speaking to the industry people, we understand that FY 21 and 22, we saw all commodity prices going up. It was only a one-way movement as far as raw material prices were concerned. And then prices started correcting. And the third quarter, the margins also corrected them because the sales realizations also moderated. So majority of the companies have maintained a low inventory level to save from the inventory losses. So inventory levels have come down. The inventory in the channel has also gone down. So going forward, keeping the all other things remaining constant, once this inventory in the channel gets filled up, probably that should provide additional demand in the FY24. But it would depend on a lot of other factors. Geopolitical tensions are going on, so we don't know how exactly those things will unfold in next financial year. But setting aside those things, with the filling up of the inventory in the channel, probably 24 could be a good year.
So looking at the paucity of time, this one question I think is the last one that we'll be taking. So how far import substitution is happening with Make in India and Atmanirbhar Bharat program? So if Hardik and Srinivasan sir, both of you can give your views on this.
Yeah. Sir, if you can give your views.
Well, what we can say is what we have done. What we are trying to do is, if this PLI scheme is basically an investment inducive scheme by the government, where they are telling the industry, you please launch an investment program where you can provide supply chain support to the downstream industry instead of depending on imports. You had certain industries applying for import restriction norms, which encourage import substitution. That means Indian producers were given the options. And while we, in our inputs, we also moved from import dependency or import majority to long-term contracts with domestic suppliers. Obviously, some element of technological innovations or breakthroughs or some modifications were there. We are not saying that it's a straight thing. But what happens is, when you take this Atmanirbhar Bharat in spirits, actually you can implement it. So you have to give opportunity. Now what is happening is, when you deal with the customer supplier, you need to give them the assurance that you are there with them for long term, and you need to be confident that their product is good. And then the pricing comes. You cannot just say that I want to get a price lower than this. You will not get success. You have to build a relationship. You have to build consistency and sustainability. And once that happens, then the benefits of long-term relationship comes in. So it's a steady progress. It is not overnight results, but it happens definitely in the benefit of India. What we are not only seeing is, in Indian industries, wherever fear import dependency is getting reduced, those industries are showing signs of real improvement, because Indian domestic demand is met by domestic players. With some capacities, spare capacities, you can sell it to the export market. This gives one thing. One is you are substituting foreign exchange, local dependency is there, and you are also exporting and you are getting foreign exchange to the country. So it helps both ways, and is helping the country in both ways. And the PLI scheme is a very, very good initiative of the government, where they are supporting the industry. Please invest. We will provide you some incentives. And if you invest and give the desired objectives as per the PLI scheme, government is there to support you. And I think that's a long way. And industries are taken it in the right spirit, and everyone is launching their own CapEx plan. I believe this is a very good step. And Atmanirbhar Bharat is a very good thing, and it should be a continuing one. It should not be stopped ever. And you should have a target. Today we don't have a target. What's the target? We should have a target that over these years, this target has to be given this benefits, etc.
Right, sir. I fully accord your views. I'd only say it's a kind of low-hanging fruits, import substitution, which specialty companies can definitely do. Thank you again to our guest speaker for his insightful views. It was a privilege to host you, Mr. Srinivasan. I'll now hand over the discussion to Mangesh to give his concluding remarks. Over to you, Mangesh.
Thank you to all the participants for taking their time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please respond in the feedback email, which is shown on your screen. Goodbye for now, and I would request the tech team to log off.